Okay, welcome everyone. Welcome to NelCapital. Welcome to what is about to be South Africa's biggest change to the trading community. And the reason I say trading community and not Forex trading or indices trading is because what you're going to learn in this group over the next 2 weeks will be how to trade any market. In fact, when we're done today, you will be able to set up your account, analyze a chart in a very simple way, and possibly place trades if you're ready for that. So let's get right into it. The first thing we're going to have to look at is what are charts and what do they consist of. So what I'm going to do, I'm running a screen recording here. You're going to go to your browser. Now, for this, what we're about to do, I never use TradingView, and I'll tell you why. It's because when you use different brokers, for example, TradingView has a broker called Orwanda or something else. Now you, for example, use Deriv or you use TradingView or some broker. The prices don't always line up, especially when it comes to Forex. So if I was to send out a signal saying buy now, stop loss is 1, 2, 3, 4, 5, but by you, 1, 2, 3, 4, 5 might be lower. Does it make sense? So we're going to look at using the same broker as well in this, but for now, we're going to look at this. So what I want you all to do, go to tradingview.com and we're just going to open a clean chart. I'm going to take something like Euro USD, for example. Now, it doesn't matter which pair it is. You can open volatility. It doesn't matter. Let's full screen this. I'm going to clean this chart. So what you have in front of you is what is known as a candlestick chart. Now, there are different ways in which a chart can present itself. You have bars, which we never use, candlesticks, which we will always use. We have hollow candles, which are a bit different, but they kind of look the same. Columns, we are never going to use this. Honestly, there's no use in using this. Then, what we also have is a line chart. Now, sometimes we might look at a line chart in order to see structure a bit better. However, when it comes to major structure, we're going to stick to candles. So, we're going to look at what do we have on a chart. We have candles. Now, this is known as Japanese candlesticks, but we just refer to them as candles. Now, these lines above and below candles are called shadows or wicks. So before we get into that, let me explain to you what this is. We are currently on a 4-hour time frame that is represented up here. Now, that means each candle represents 4 hours of movement. All right? Meaning within this one candle here, you will have 4 1-hour candles. But within a 1-hour candle, you will have 4 15-minute candles or 2 30-minute candles. And as you break it down, you can break it down in halves or quarters pretty much. Now in trading, we will always use quarters. So for analysis, we will start on, for example, a weekly or monthly, depending on what pair you trade. We can start on a monthly, a weekly, daily, hourly, which will go from daily to 4 hours. From 4 hours, we'll go to 1 hour. And then from 1 hour, we will go over to 15 minutes or 30 minutes. 15 minutes, we can break it down all the way to 5 minutes. 3 minutes, 2 minutes, 1 minute. Okay, so now that that's clear, what we see here is wicks or shadows, as you might call it. Now that simply means, like, it indicates movement on a smaller time frame. Okay, so why are some candles red? Why are some candles green? It's because where one candle closes, another one opens. So for example, this candle closed red. Why? Not just because the market went down, but because it closed below where it opened. If a candle closes above from where it opened, it's considered a bullish candle, and therefore it'll be green. Now you can change these colors in your charts, and we're going to go over that as we kind of go over MetaTrader and how to set up those things. But when you look at these, for example this, you have a bearish candle and a bullish candle. But here you have 2 consecutively next to each other. Also 2, here's 3. Now it doesn't matter, they will look different and there's different candlestick patterns, and those are things you will have to do for self-study. But simply put, if a candle is red, it means it closed below from where it opened. Therefore, it's considered a bearish candle because it went down. If a candle is green, it closed above from where it opened. Now, when you look at a candle like this, it opened here, but now there's a wick above it, there's a wick below it, but it closed there. How does that make sense? Now remember, each candle represents smaller time frame movements. So for example, on this 4-hour candle, this particular one here, the candle might have opened, pushed up, got pushed down again all the way to here, and then just before it closed, got pushed back and closed there. So for example, let me get some squiggles here. For example, when that candle opened, it might have done something like this, push down, and that. So that will be where it closed, and this will be where it opened. So that there will be what shows your 4-hour candle. But this whole move might be a 1-hour candle, or like 1, 2, and then 3, and then 4. Those might, for example, be your 1-hour candles. Okay, so now you know what is going on. You have candles. Candles have shadows, or wicks, as we call them, and depending on the color of the candle, it's either bullish or bearish. Bearish, it went down. Bullish, it went up. Now, the way we describe this in the trading community is, if you look in the nature, we use bears and bulls. When a bull attacks something, it comes from the bottom and pushes it up. Therefore, when something goes up, it's considered bullish. When a bear attacks something, it stands up. It grabs it from the top and it pushes it down. Therefore, bearish. So what we have here is a bullish chart. Why do we say it's bullish? Because if you look from here, it went up. Okay, we're going to get into market structure and that in a short while. All I want you to know for now is that when you open a chart, you're not completely flabbergasted by what you see. This is what a chart holds. A chart holds candlesticks. On the right, this is where you have price, and on the bottom is usually where you have time. So right now we are on a 4-hour time frame, so you can see here that was 12 o'clock from the 18th and the 23rd. So you will see at the bottom, if you hover over it, it shows 18 January, 8 o'clock, 12. You see, because each candle is 4 hours. Now, if we go into 1 hour, you will see this candle is currently still open. So here you have 27th, 4 o'clock, 5 o'clock, and we haven't yet gotten to 6 o'clock, but you can pretty much plan all this out. Does this now make sense? If I was to highlight, let's say, what's the time? That means this candle just opened, this 1 hour candle. So we're going to go 1, 2, probably from here. I'm going to mark this. All right. If we now go back to that 4-hour time frame, can you see what part I marked? Can you see, because a candle just opened, that's the candle that's still running. So the first candle is probably here. So we already have let me see what time this candle opened, 12 o'clock. So 4 o'clock, that is where this 4-hour candle closed, which means the next candle pretty much opened an hour ago. So inside this, we have 2 1-hour candles now, and by 6 o'clock or 8 o'clock, it should close. Now, when you look at a chart like this, you have to understand there are a couple things that drives the market. Now, when it comes to Forex, stocks, and crypto, 3 things majorly drive those markets. We're going to get to synthetic indices in a bit, but 3 things mainly drive those markets. The first one is technicals. Now, technicals is considered your technical analysis. That is you as a trader doing your analysis on the chart to try and figure out a bias, to try and figure out what the market is going to do next, whether it is going to go to certain zones to retest so you can buy or sell, or what pattern it's forming. That's pretty much what technicals are considered at. Now, a lot of you guys, whether you are new or experienced, might have heard of indicators. We do not use indicators. No professional trader uses indicators. Maybe people will look at things like volume, but that's only if you trade like massive amounts of money. The reason you don't use indicators is indicators lag behind, which means whatever you see now, if you're waiting, for example, for 2 arrows to cross each other in order to tell you to buy, by the time those arrows cross, the markets, or you've already missed your entry, because the market had to make that move in that direction in order for those indicators to show it. That's why when you leave here, you will not be using indicators or any of that lagging things. We've all been there. I've used them when I started out 6 years ago. In the end, it's better to not use them. Secondly, after technicals, you have fundamentals. Fundamentals are whatever happens in the world that can affect markets. So that's like news, that's war events. You know, like we have the thing going on between Russia and Ukraine, and that has caused massive spikes and massive disruption in the oil industry. For example, if you trade a pound-dollar pair and Boris Johnson comes and messes around with Brexit, in one moment, your trade, which would have been highly profitable, can be influenced and the market can change direction just because some news event happened that caused the currency to either lose value or gain value. And then thirdly is your bias. That means if you look at this chart, you already can see it's going up. Okay, for example, now this is an example, not this chart specifically, but for an example, you can see it's going up. Your analysis shows that it should come back to a certain point and then you can buy up because that's what the structure shows you. Fundamentals sound good. Example, something happened in the country, the currency seems to gain strength. So yeah, value of the currency is going to go up. Those are your three things. You've got your bias. Your bias is just because I look at this, it looks like it's going to go up. That is my bias. You've got your technicals. My analysis shows it's good. And your fundamentals. News events looks good. Those are your three things to look at. And if you trade pairs like Forex, NASDAQ, gold, which are they're indices, but they're not synthetic indices. So if you trade Forex, NASDAQ or gold, crypto especially, oil, stocks, those types of things, you have to look at fundamentals. News can seriously mess up your trading if you do not take it into consideration. Now, when it comes to synthetic indices, you'll see on NelCapital, we specialize in volatility. Yes, you get boom and crash, but those pairs, they're not worth trading. And the reason I'm telling it is because you can't use risk management. Yes, I've traded it, I've scalped it, I've made money, I've also lost money. For example, I see people on crash taking buys. Now, yes, the crash market sometimes moves up, but what happens is if you take a buy and you put a stop loss of this big, when that candle crashes, right, it doesn't take you out by your stop loss. In fact, it actually takes you out where the candle closes. So if your stop loss is this big, but the candle closes down here, it's going to give you all that loss and then only kick you out the market. So you can't use risk management. If you want to trade boom and crash, please, only buy on boom, only sell on crash. If the market goes up, doesn't matter. Eventually it'll come back down. It's cool. But risk management on those pairs don't work. Okay, we focus on synthetic indices like VIX. Now, VIX or volatility index is the fear index in the market. That means if investors fear investing, it pushes the S&P 500 down, which means the fear in the market goes up. When the fear in the market goes up, that means the VIX indices go up, or the VIX indexes go up. All right. Now, your most volatile pairs are VIX 75 and VIX 100. We do have VIX 300, but that is really nice to trade if you have small accounts. Other than that, you also have VIX 10. We don't trade that. That is too slow. And we have VIX 25 and VIX 50. VIX 25, VIX 50, you can really scale on big lot sizes because the margins are super big. Like you can have 30 cents and I think you can trade VIX 300, for example. VIX 75, VIX 100, you do need $20 minimum for VIX 75. VIX 100, I'd say to apply proper risk management, at least $100, just because it moves so quick. Cool. We've looked at candlesticks, we've looked at how they move, we've looked at the colors of them. Next, we're going to move on to market structure. Okay. Now, market structure, we have bullish structure, and we have bearish structure, and then we have ranging structure. Okay, so we're on the charts. I'm going to show you exactly how market structure works, whether it's bearish, whether it's bullish, or whether it's ranging. So let me go out to a daily time frame. I'm just going to look. This is not a pair that moves a lot, so we're going to look for some good structure here to show you guys what it is. Okay, so in structure, you have impulses, and corrections or pullbacks. Now, corrections or pullbacks can also be referred to as corrective movement. All right, so that's pretty much where the market corrects itself. For example, it's going to look something like this. Now, you've got an impulse, a correction, an impulse, a correction, and an impulse. Now, here's the thing, and this is very important to understand. When the market makes a pullback or a correction, that pullback or correction can either be this short or this long, okay? And the problem most traders make, and I know a bunch of you guys on here, I guarantee you will be doing this. The market, for example, as you see here, will go up, but as soon as it turns down, most of you will sell. In a bullish market, you never want to sell these corrections simply for the fact that irregardless of what zone you have here, you cannot never be sure that it's going to go all the way back down to that zone, because it might go down this far or it might do a small pullback like this, if that makes sense. Now, if I have to draw this for you, those lines aren't individual candles. Keep that in mind. So when you have an impulse and a correction, it's not one candle and one candle. An impulse, for example, will be something like this. You have an impulsive move, a short corrective move. An impulsive move, corrective move. Now look here, you have a very long impulsive move, pretty much almost to here. And then from there you've got a short corrective move. Now this is the thing, and we're going to cover this a bit later on, that's considered market structure. But if we go down to a clean place, I'm going to show you this. Okay, so when we go down to a clean place here, I'm going to show you nicely how structure works. In a bullish market, now remember, bullish is up, all right? You have an impulse, a correction, an impulse, correction, and an impulse. Now notice I've drawn these corrections very nicely. Don't be too phased about it. Simply what that means is the market will go like this. You will have candles, and then it'll come back. You have candles, and then you have more candles. It's bullish, bearish candles, doesn't matter, but that's simply how it looks. And then in a bearish market, what you also have, same thing, impulsive move, corrective move or a pullback, impulsive move, corrective move, impulsive move. Now, in either of these markets, and in a bullish market, you have higher highs and higher lows. In a bearish market, you will have lower highs and lower lows. Okay, so this point here is a higher high. Why? Because this point is higher than this point. So this is a high and this is a low. That's why this is called a higher low, because this low is higher than the previous low. In a bearish market where you have lower highs and lower lows, you have a lower high here because it is lower than this high point, and you have a lower low here because it is lower than this low point. All right. Now, notice what happens here. Notice how we have a high, and the market breaks it to go make a new high. And the same thing happens here. Okay? In order for the market to continue going in a bullish direction, it needs to continue breaking structure. Breaking structure means it needs to continue making new highs and new lows. The same with a bearish market. We have lower lows, and in order for that to continue happening, it needs to continue breaking the lows to make new lows. The same here. So in a bullish market, we break the highs. In a bearish market, we break the lows. Now, what happens in a ranging market, because that is something I have mentioned. A ranging market is simply when the market consolidates. It can look like this, for example, or it can look something like this. All that's happening here is the market's consolidating. There's no clear momentum. The same here. There's no clear momentum. There's no clear movement because it's staying in a range. Now, I know for a fact there are people on here that will trade this small break of structure here. All right? That's not how it works. We're going to get into it, and this is why you're losing money. I'm going to backspace this. Now, very, very, very important. You know now what is bullish structure. You know now what is bearish structure. For the market to go from a bull market to a bear market, what needs to happen? Take a couple of seconds, think about it. Cool. If you don't know, for a bull market to change into a bear market, it needs to fail to break structure. Okay, let me see if I can move this over. I'm just going to move this a bit over. So what now needs to happen? We have this, it just broke structure, okay? Market's going to come. It's going to do its pullback. Now the pullback can be to here, it can be all the way down here, doesn't matter. But now, for example, the market's going to come make a higher low. Now it's going to do something like this. It's going to make a lower high, or it can even be an equal high or a double top. Doesn't matter. Let's just say it's failed to make a new high. Boom. Now it makes a new low. All right. Market's doing something. Market's doing something. Now this has too many lines, but that's all right. Here's what happened. The market has failed to break structure. We can make this even or we can make it here, it doesn't matter. It's failed to break structure. It's failed to make a new high. What it has also now done is it has made a new low. This does not mean you now start selling the market, okay? And this is on high time frames. This is on 4-hour time frames, 1-hour time frames. This does not mean you're going to go here and sell. Why? Because the market's going to come back to a zone which is going to retest. We're going to get into those zones in a bit, but important, for market to change direction, it needs to break structure. Markets can, especially fundamental markets, can have a thing called a fake out. For example, I'm going to show this to you very clearly right now. For example, what can happen? Market can fail to make a new high. It can make a low. And boom, you could have been faked out, is what we call it. Now this happens mostly in fundamental markets where you have news that play influence, where the market was trying to change structure, something happened, some news event happened which caused it to not follow its structure and break. This happens in fundamental markets, Forex, NASDAQ, gold, oil, stocks. Volatility doesn't really ever happen because by the time news affects it or the fear goes up or down, it's been 2-3 days. So it's very important that when the market starts changing direction, okay, you've got a failed to break structure, you've got a new low, doesn't mean you sell it yet, okay? You don't sell that bear market yet because you haven't gotten confirmation from this final pullback or correction, okay? On that pullback or correction, what's going to happen is a thing called a retest. A retest is where the market comes back to a certain zone, which I will explain to you. It gives you a candle behavior, not a candlestick pattern, which I know you buggers have heard of, not some Fibonacci thing, because Fibonacci doesn't work. If you tell me Fibonacci works, I'm going to tell you why you say it works. Fibonacci is a mathematical equation that you draw on a chart. The only reason it sometimes works on popular pairs, not unpopular pairs, on popular pairs, is because so many people use it and so many people believe that it works. Therefore, if all those people on that chart uses that tool the same way for that one particular move, it'll work. We will never use Fibonacci in trading. It's not how the actual market runs. It only runs on popular markets if and only if 99% of people trading that market moves it. Okay, let's not get off course. So now you guys know from this small section what is a chart, what goes on a chart. You guys know what a candlestick is, you know what it consists of. Okay, you know what market structure is. Bullish market, bearish market, higher highs, higher lows, lower highs, lower lows. Okay, you also now know how a break of structure happens. Now before I finish off this section, I'm going to show you on this chart clearly what the market structure is and how it changed. So I'm going to clean up this chart again. And let's just look at this. This is the Euro USD. This is a daily. Now, I don't know if I need to clearly draw this out for you. I think it's pretty self-explanatory. Now, if you struggle in the beginning to identify impulsive and corrective moves, do not feel stressed or bad to ask me or anyone on this group to help you, okay? In the beginning, for everyone, it's kind of hard to differentiate what is really a pullback. Like, for example, what is this? Is this a pullback? Or is that the pullback? I get it. In the beginning, it's quite challenging. right now. It gets better with time. Be patient with yourself. It's going to work. So now, if we look at this, you have an impulsive move, a corrective move. You have an impulsive move, a very short corrective move, and an impulsive move. Notice how weird these lines look. Notice how they're not perfect. Notice how you have a long pullback and you have a short pullback. You see now why we do not buy or sell the pullbacks in a market that's already going in a direction. Now I want to show you really interestingly what's going to happen here, or what is happening. As you can see on this impulsive move, we have formed a low. Alright, there's your low, and there's your lower high. Now what happened here? Here's a new low. Sorry, this thing is tripping out a bit. There's your new low point. I don't know why it's doing this, but anyways, there we go. There's your new low. Notice how where these candles closed are lower than this. The reason I didn't take this as a low point, if we zoom in here, you see we have a wick right down here, that wick. Notice how these candles pushed lower, but they didn't close lower than those wicks. However, this candle right here closed lower than those wicks. Remember, wicks indicate movements on smaller time frames. They are very important to take into consideration. Now, I'm going to show you where we have a break of structure, and this is where the market is changing its direction. Okay? What we have here, we have a lower high. Ooh, we failed to break structure. We wait. Okay, now we have a higher high. What do we need? We need a higher low or an equal low, considered a double bottom, which is also part of failing to break structure. On that point, that is where you can place a buy or a sell and continue in your direction. Okay, what do we have here? Boom, we have an equal low or a higher low. They're pretty much the same, but you can kind of see the one's a little bit higher than the other one. So now you have a failure to break structure, a break of structure, and another breach. Okay, a breach or another break simply meaning it didn't go back and make lower lows or lower highs. And boom, look at this impulsive move. Look how big this guy is. Look how big this guy is. Okay, so now notice here what happened. This is very, very important for you to understand, because if you don't understand this, this is mostly what messes with most of you guys. You have a lower low, a lower low, a lower low. You have a lower high, and a lower high. Now let's mark this last lower high, okay, because it's very important. Look what happened here. You have a higher high. All right, let me drag this on. You see what happened? The market pushed up. Notice how the market goes up and down and up and down, up and down, and how this is a move and not every individual movement is a move. It closed above. We have a break of structure. Now, let's mark this low. I'm going to mark that wick here just so you can see exactly where it is. Sorry, this is messing around. Look at that low, all right? Now look at where the new low is. You see that? You see how it's like little steps? You see how we have these lows, and now all of a sudden the low points are going higher, and the high points are going higher. You have a failure to make a new low, which this was your previous lower low, and you also made a high. So you have a failure to make a new low, a failure to break structure. You then actually broke structure, you made a new high point. And then for a third time, you failed to break structure. So you made a higher high or a double bottom and not a lower low. At this point, and this is what I'll show you where to identify it in the zones, this is a prime example of where we will place our buy entry because we want to buy. You want to buy low and sell high. Important as well. Don't know why I didn't cover that, but you want to buy low and sell high. When the market changes direction, when the market goes up, you want to take a buy at a low point for the price to shoot up, and that's where you make your money. If the market goes down, you want to sell it at the top, at the highest point possible, and that is where the market goes down, and that's where you make your money. Let's take a quick breather and then we will get back into the next section. Okay, let's get back into this. So, previous part, we have covered what goes on in the chart. We have covered candlesticks, we have covered what they are, we have covered why they look the way they look, and we have covered market structure and how to identify the break of market structure. Cool. Pretty much a quick recap on the first section, and I'm pretty sure it is at this point that most of you guys have, maybe like if you're experienced, maybe you've kind of snapped like, okay, this is properly how market structure works. Some of you might know this, some of you might be very well clued up with this, some of you might think, what's this guy doing? Anyways, doesn't matter. You guys now all know market structure. Cool. Okay, now before we continue, if you want to take a screenshot of this chart, we're going to come back to this later once I've explained risk management and entries and supply and demand to you. And I'm going to show you exactly where I would have taken this trade. I'm going to show you exactly how small our stop loss would have been, how big our TP would have been. Now, a stop loss, that simply means that is the amount that you're risking. For example, if you take a buy trade at this area and you put your stop loss down here, let's say your stop loss is $10. That means if the market comes down to this point and your account goes minus 10, it hits your stop loss, the market will take you out. It will take that $10 loss and kick you out the market. Opposite goes for TP. If your target is $30 or $50 or whatever, once the market reaches that amount profit, it hits that certain area that is your target, it's going to take that profit and kick you out the market. Now, what we're going to look at right now is the difference between support and resistance and supply and demand. Now, I'm going to say now a lot, but it is important to understand, and I know a lot of the guys in here that's been trading for a very long time, some people might be very fixated on support and resistance. What I'm going to show you right now is the exact reason we don't use support and resistance in the way everyone else would teach you to use it. And we use supply and demand, strictly supply and demand. The reason we use supply and demand, okay, and this is coming from a business perspective, but also this is how the world works. Every market, whether it is synthetic or real, like FOREX or oil, all those things, the world runs on supply and demand, which firstly should tell you, okay, why would anyone use anything else on supply and demand? The world runs on supply and demand. The markets run on supply and demand. You want something, and I can supply it. So therefore, equal supply, equal demand. If 100 people want something, and I can only supply 10 of them, high demand, low supply. If I have 1,000 pieces to sell, but only 10 people want it, that's a very high supply, a very low demand. And that's exactly how the market works, okay? Certain things, especially fundamentally, influence the market in a way that causes higher supply or higher demand. The markets range between those zones. Right now, we're going to look at the difference between supply and demand and support and resistance. I'm going to show you how much more accurate supply and demand is compared to support and resistance. Now, yes, sometimes a support and resistance line is very close to a supply and demand line. But when you take into consideration the wicks and how the candles move, which I've told you is very important, you will come to realize that extra level of accuracy that a supply and demand or support and resistance zone gives you. So if you want to take a screenshot of this chart, we're going to come back down to this exact point a little bit later, but for now, we're just going to clear it and zoom out a little bit. So let's remove the drawings. I'm going to go out to a monthly time frame because this is Forex. We have years worth of data to work with. So remember how I told you those candles are very, very important. So for support, you want at least 3 candle wick touches. A lot of traders will tell you use the opening or the closing of the bodies. You are throwing away movements that the market made on those smaller time frames, and those movements are very important. So if you're going to use TradingView, and I will show you how to set all this up on MetaTrader because that's where we're going to analyze 99% of our work. If you use TradingView, you have a thing called a horizontal array. I'm just going to use that. You can use a line. I'm going to use array. What you want to look at for support, think of it this way. Market comes down. It hits an area can't go through. It is being supported, all right? Hits an area, goes up, can't go through. Resistance, same thing. Market comes from the bottom, hits an area, goes down. It gets resisted. That's an easier way to think of things. If we were to look at a support zone, for example, let's say down here, we want at least 3 green candlestick touches, okay? So let's see where we find those. We have 1, 2, 3. Perfect. I'm just going to make this a solid line. Now, where's our touches, you might ask? We have 1, 2, 3 touches. Yes, the market has pushed lower, but that might be a news event or something might have happened there. It doesn't matter. You want 3 touches, okay? Now, these are called regular support and resistance areas because it's just like horizontal. We do get diagonal areas. That is used to show the trend of the market, but we don't trade with those. Okay, so we have a monthly support here. I'm not seeing very clear resistance areas compared to if I look to like top side red candles. We only have 2 here. We only have 2 here, and we only have a couple down here. So what I'm going to do is I'm going to go from monthly, I'm going to go into weekly. On this, you might see a little bit more support and resistance areas. Let's see what goes on here. That's 1, 2, and what's that? That's the close of candle. 1, 2, 3. That looks pretty good for me. Why? Because we have a very short wick. It's now just slightly covered by that candle. You see there's a very short wick. 1 getting touched there, and we can might as well just adjust that a little bit to that. 1, 2, 3. No, that's invalidated. Okay, let's actually delete that one. We must be very accurate in our analysis. Let's see what goes on down here. We have 1, 2, 3. A very strong resistance line. 1, 2. Where is that? Yeah, there we go. So I'm actually missing this now. We have 1, 2, very close, 3, 4. We can count that 3. That's resistance. You see how the market breaks out here? Okay. Let's just use these 2 support and resistance lines for now because I want to show you how we identify supply and demand. So I'm going to get some squares here. A demand zone, and this is something someone asked me yesterday, and this is how you identify it. When you have a demand zone, let's draw a candle here. Imagine this is a red candle. I'm going to make it red. And we're also going to fill it with red. Cool. And then we're going to draw a big impulsive candle like this. This is a bullish candle. This is a green candle. Now candles have wicks. Okay. Please don't forget this. Candles have wicks. Let's keep the wicks yellow for now because it doesn't matter what color they are. You know it's from a red candle or green candle. Now, how you identify supply and demand. A demand zone is the last red candle followed by an impulsive bullish candle. So the last red candle followed by a green candle. Now, you are going to draw your demand zone area from the start of the red candle, the opening of it, and the bottom of that demand zone is going to be whichever wick is the lowest. For example, you get a rectangle like this. You're going to start here, you're going to draw it to the bottom of that, and that is going to be it, okay? Let's make it faded like that. Let's fade that color. That is your demand zone. Now, where does the demand zone happen? A demand zone happens somewhere in an impulsive move, okay? Why this is important is because the market will always come back to a demand zone to retest it before continuing onwards. If it breaks this demand zone, that can be considered a break of structure, or it can go back to a previous demand zone. Because if you have an impulse correction, impulse correction, impulse correction, you will have demand zone, demand zone, demand zone, demand zone. If the market doesn't come back to one, but it continues going down, that doesn't mean you start selling because you haven't actually broken structure. It might just go back to a lower demand zone. Only if it bounces up from that lower demand zone or whichever one and fails to make a new high in a bullish market, then you have a failure to break structure. Important. Now, a supply zone is literally the complete opposite of a demand zone. A supply zone will be the last green candle or the last bullish candle followed by a impulsive bear candle or an impulsive red candle. Yet again, you will then, for a supply zone, start drawing your zone at the opening of the green candle, and it will close on whichever wick is highest between the red and the green candle. Now, if you have another candle like this, maybe say next to this candle, whether it's green or red, doesn't matter. Let's say we have another candle here. A little candle like that. Okay? Doesn't matter. If this candle's wick is down here, then you will choose the lower wick. Okay? But you have to choose the highest wick of either candle next to it, or if it has the lowest wick, you choose that. The same goes for a supply zone, the opposite. If you have a bull candle followed by an impulsive bear candle, all right, you're going to start your supply zone at the opening of the bull candle. Now, if there's a candle to the left of the bull zone or the impulsive candle, whichever one has the highest wick, you're going to draw it to that. Makes sense, because the market needs to come back. Now, I'm going to show you all a little trick. And the market does this on every market. Whether you're trading NASDAQ, whether you're trading gold, whether you're trading volatility, the only difference is this happens on various different time frames. And this is one of the secret ways in which we big traders or the banks or the hedge funds, this is the way they enter, this is the way they play stop losses, this is the way they play CPs. Now, remember market structure, what you were shown, right? Market structure is not only a 4-hour, a 1-hour, or a daily thing. Market structure happens all the way down on 1 minute. It happens all the way over on weekly time frames. Now, on VIX 75 specifically, I have found that this pattern happens on the 15-minute time frame. Given it happens on all pairs, Forex, NASDAQ, it even happens on crypto. It might just depend on what time frame, and if you specialize in a pair, you will find that either happens on 5 minutes, 10 minutes, or 30 minutes. What will happen is, and this is very important, this is why you guys get stopped out. The market now pushes up. All right, market pushes up, does its thing. Now it comes back down, does that whole shebang. The market is going to come back. In a demand zone, it'll wick lower. This is very important because this is where you are going to make your money. This is where you're going to get your accuracy from. This has to be red now because it's a bear candle. In a demand zone, very, very, very important. Remember, the market's coming back down to a demand zone now. What's going to happen is, if a green candle, a bull candle wicks lower, you don't do this. What is going to happen, and please, this is very important, the market is going to come back to a demand zone. You will have a bear candle that will wick lower than the zone, okay? Not just like here, it'll severely wick lower. That's usually called grabbing liquidity or stopping out other buyers. This is where most people's stop loss gets hit. If a bear candle wicks lower, and very important, it has to close either inside the zone or above the zone. So even if it's a small candle with a massive wick, it doesn't matter. If that happens, you then wait for a bull candle to follow. Now, if the next candle is a bull candle, it doesn't matter if the candle is impulsive or whether it's short like this. It doesn't matter. And even if this bullish candle has another wick that goes like that or like this, it doesn't matter. The only important thing is you have a bear candle that wicked lower and closed inside or above. If the next candle is a bull candle, whether it's big or small, if that candle closes bullish, that's where you place a buy. This is where you put your stop loss. You put your stop loss just a couple pips. We'll get to what a pip is. Below that wick. Okay, now you zoom out. And what you're going to do is your TP is going to be previous supply zones. Remember, we are trading market structure. I know this is a lot of info to take in. Remember, on a demand zone is formed. I'm going to say it one more time. A demand zone is formed. The last bear candle before a bullish impulsive candle. It needs to be an impulsive candle, not just a small candle market, an impulsive candle. That is your demand zone. A supply zone is the last bull candle followed by a bearish impulsive candle. On a demand zone, the market will come back to a demand zone. Depending on what time frame, it will create a wick that is lower than that zone. Important that that bear candle on a demand zone must be a bear candle. If a green candle wicks below, closes inside, and then gets followed by another green candle, no, you wait. A bear candle will wick below, close inside. The next candle has to be bullish. Even if you have a bear candle that wicks below, closes, and you have 2-3 more bear candles and then a green candle in the zone. It wicks below. The next candle closes green or bullish, you buy. You put your stop loss just below the lowest wick. And you put your TP by previous supply zones. Remember, in a bullish market, you have higher highs, higher lows. You have supply zones, you have demand zones. In a bullish market, the market will take out previous supply zones. Pretty much go back to retest them, but then violate them. So the market pushes up, it goes and takes out previous supply zones. Up until it gets to a very strong supply zone, it will fail to break structure, the market will turn bearish. In a bearish market, it will take out previous demand zones. Okay, what I've shown you here is one of the secret ways to get very small stop losses and insanely huge TPs. Okay, because a lot of people get stopped out by these wicks. They will put their buy here, they'll put a stop loss just here because they don't want to risk too much. But also it's because their entry will be all the way up here. So you will have a massive stop loss. This is where patience comes in. Okay, this is a very key thing. In a supply zone, the opposite is going to happen. You will need a bullish candle to wick above that zone and close inside, followed by a bearish candle. Once that candle closes bearish, you will place a sell, you will place your stop loss above the highest wick. Your TP will be at the first demand zone beneath it. Cool. That usually gives you risk to reward ratios of 1 to 8, 1 to 9, 1 to 10, 1 to 20. It all depends. I have now shown you support and resistance. I have now shown you supply and demand. I have now shown you one of the secret ways in which you take entries on any market to have very small stop losses, very big TPs. And usually what you'll find is once the market has created this wick movement, it usually shoots. The next couple candles shoot in your favor, which gives you more than enough time to place your stop loss on break even or in profit. Okay, now there's a lot you guys still have to learn. We will cover a lot in upcoming videos. This video itself will be long, but bear with me. This is enough to get you going. Okay, I'm going to stop that recording right there. So now we're going to just talk about general something which is considered, or it's called risk management. Now here's where it is very important, and this is something where your psychology as a person is going to play a very big role. In fact, your psychology in trading plays a bigger role on how profitable you are compared to the amount of money you have. If you have $1 million and your psychology is terrible, you will lose money. You will lose money every time, okay? It's very important that you understand risk management. Now, what do we mean by risk management? When it comes to trading, you want to always use percentages, okay? If you have a $100 account, yes, it's going to be very hard to only risk 2 or 3% because that's $1 or $2 or $3. So you're going to have to risk a bit more capital. So when you have small accounts, we will say use a set amount. I'm going to get back to percentages now because I'm talking a little bit all over the place. Small accounts, we're going to use amounts. Big accounts, we're going to use percentages. Profits made, always percentages. No matter how big your account is, always percentages. Let's say you have a small account. You will tell yourself, for every trade I will take, I will not risk more than $5 or $10. For example, $2, $3, $4, $5 per trade. Even if you take 3 consecutive losses, you cannot risk more than your fixed amount per trade because you have to be consistent. And always never risk anything less than a 1 to 3. Never. 1 to 2s? No. 1 to 1? No. I'm going to tell you why. If you have a 1 to 3 risk to reward ratio minimum, that means if you risk $5, your target is $15. Even if you close your trade at 10, it doesn't matter. 1 to 3 minimum. That means you can take 3 consecutive losses in a row, which means you've now lost $15. Your fourth, that means if you lose 3 trades in a row, it only takes 1 trade to make back 3 losses. Does it make sense? So if you lose 5, 5, 5, you've now lost 15. 1 trade makes that back. Therefore, never less than 1 to 3. If you have a 1 to 2, you got 2 trades, pretty much. After that, it's going to take more than 2 trades to make it back. So we will never risk less than 1 to 3. Usually my trades are always 1 to 5, 1 to 7. It's very high, and we're going to get into that a bit later. Now, we've covered that part of risk management. If you guys, and I'm going to have all of you start with nothing more than $20. You can put $10. I wouldn't go less than 10, nothing more than 20. What we're going to focus on once you guys now actively start trading is we're going to focus on how you as a trader can take $20 maximum. Even if you take 10, that's fine, but $20, nothing more. And every week you must be able to flip that at the beginning to $50, $60, $70. You're going to withdraw your profits, but you're going to leave that initial 20. Okay? So you withdraw profit, but you leave that 20. That is your initial investment. What happens is after you withdraw that profit, that now means that what you're trading with is technically profits. So you have no more, you're not supposed to have any more psychological connection to that money because it's profits. You didn't have it in the first place to begin with. Once you guys get to a point where you are able to flip $20 to at least $150, $200 every week without my help, okay, then you can say, now you can put in more money. But irregardless of how much money you put in, your risk to reward ratio must always be consistent. You can always trade. One trade is a 1 to 3, the next one is a 1 to 5. But you can never go less than 1 to 3. Okay? That's what I recommend. Now, also important, if you say, for example, you have a small account and you say, okay, I'm going to take a 1 to 5 risk to reward trade. Now the trade runs, you lose that trade. Your next trade on that same pair has to be a 1 to 5 again because you have to follow it like to make it back. Does it make sense? If you risk $20 to make $60, now you lose $20, right? Your next trade can't be, I'm going to risk $50 to make $150 because I need to make back a loss in profit. No, because what's going to happen is you're going to revenge trade and you're going to end up losing money. So please, always risk management. If you have a small account, stick to consistent amounts that you will risk and consistent amounts that you will target. Even if the thing hits your TP and it continues going up or down, for example, you've made your money, get out the market, rest, recover, close the charts, leave, okay? It's very, very, very important. Then what we're going to talk about, we've now covered the basis of risk management. Now we're going to talk about psychology, greediness especially, because I know a lot of people here are in a position where they need money. And this is where you're going to fuck yourself up. And I'm sorry to speak this way, but this is the cold hard truth. We've all been there. I don't want you guys to be there. What I'm showing you in this and what I'm going to show you in the next couple of days, it's going to help you like mitigate so much losses. Like you're not going to, like you guys will not nearly make as much losses as I've made. And this is why I'm here, is to help you. So please listen to me as we go through this journey. If you have $50 in your account and you know this is the last $50 I have, first of all, you shouldn't be trading with it then, or at least put in $10 and keep the 40 in a safe space, okay? But anyways, if you put your last $50 or $20 or $10 into an account, first of all, risk management, because you need to try and get as much trading opportunities out of that small position or small amount that you can. But second of all, if you put in $10 and you now lose $5, of course you're going to feel stressed because now you need to make $10 to make a profit on top of, or you need to make $6 minimum to make a profit on top of your $5 loss. this is where psychology and greediness kicks in. Please, if you take a loss and the trade goes in your and the chart goes in your favor, sit it out. If for some reason we take a trade, our stop loss gets hit, and I see, okay, we have another opportunity, we jump in again, our stop loss gets hit a second time, that is it. I'm done. We leave it. We do not trade that pair. We leave it. We let the market make its moves, because we never know what is happening, okay? If we trade a Forex market and I know the analysis is on point and I share a signal, we take a trade, stop loss gets hit. If I then see, okay, the market had a fundamental move, it now looks to be in my favor, I will probably say enter again with a new stop loss, a new TP. Okay? If we get stopped out again, I am not touching that market. I'm not trading that pair again for the rest of the day. I'm letting the market make its moves. And I need you guys to do the same, because what's going to happen is you're going to learn to trade very profitably now. You're going to start making money. Now you're going to take a couple losses. You're going to think, but I'm good. I'll just do this, do that, follow Dearwood's instructions. Maybe I'll get this movement. I'll take that signal. I'm going to go hard. You blow your account. Then, shit, now I need to trade, I need to make money. It's called revenge trading. Do not do that. Very importantly, if you take 2 consecutive losses on the same pair in the same day, for example, you take a trade, stop loss, take it again, stop loss, leave. Close your charts, make yourself coffee, go outside, go for a run, leave. Clear your head, okay? Because you might think to yourself, okay, I'm fine. I've lost 10, I'm fine. Have you ever lost $3,000 and told yourself you're fine? Have you lost $10,000 and told yourself you're fine? I've lost $7,000. I told myself I'm fine. I kept trading, lost more money, until my mentor closed down my laptop and said, leave. Guys, if you lose 2 consecutive trades in a row, close your laptop, take a break for a day or 2, leave. Once you come back, you open your charts. You clean your charts. You draw new support and resistance, new supply and demand, new trend lines. We're going to cover all that, but you clean your chart and you start fresh every time. Okay. The way we trade, I'm going to show this to you on the pair that we use to obviously identify market structure is, and this is what makes NelCapital and my mentors different. We trade, or we enter our positions where the market changes direction. Okay? What does that mean? The market goes down, boom, break structure, comes back, we enter there, so the market goes up. Now, this is some self-studying that I want you guys to do. We are not going to use it a lot in trading, but it is important that you understand and know and are able to identify these things. In the future, I'll make shorter videos focusing just on these patterns and showing you how to identify them. But please, for self-studying, go and self-study continuation patterns and reversal patterns. Okay, because this is important. The way we trade, we enter where the market changes direction, which means we have very small stop loss areas. We have massive TPs. I've flipped $1 to $130 in one day. Okay, it can be done. Our entries are very accurate. Now, what happens if we miss that entry? What happens if we see the market change direction and we've missed our entry point? Well, that is where you're going to use things such as continuation and reversal patterns to get into it. You might see you have something like a bull flag or a pennant. Yet again, when the market makes those patterns, it targets smaller time frame supply and demand zones. That is how you enter. Very little trick that you didn't know. I bet you didn't know that. We will cover those things, but for now, please, risk management, important. Psychology, important. Yes, I have notes here. I've shown you how market structure works. I've shown you what goes on the chart. I've shown you how to do these things. These are very basic coverages. I've even showed you one essential way on how to enter these supply and demand zones. And it's also important to know that wick pattern doesn't always happen. It's one of many ways the market retests a supply and demand zone. One of 3 ways, actually. Okay? And we will get deeper into those ways in future videos. But it's important for now you guys understand what we've covered in the first section of this video. It's important that you understand how to identify supply and demand zone along with market structure. And it is important that you guys work on psychology and understand risk management. Okay. take a short break, come back to the next section in a couple minutes. Okay, so now that we're back, we're going to go back to that Euro USD chart I guys told you about. I told you I'm going to show you how to identify the change of structure. I'm going to show you how I'm identifying the supply and demand zone and where we would have taken that buy position. I'm not sure if this camera is even. Anyways, let me show you that. So we can clearly see we have previously identified the lows, the break of structure. Now remember, in an impulsive move, this is a very short impulsive move, we have that supply and demand zone, right? So now here's what I'm going to show you. When we draw the zone, exactly as I said, the open of it to the lowest candle. Okay, this is a prime example of when the market doesn't give you those wicks. Maybe it did, maybe it didn't. We're going to find out right now. Let me actually do this, because I want to zoom in. I want to show you guys previous supply zones as well. We have a supply zone here. I'm not going to target that. Let's target one of these zones. Maybe up here. Okay, I'm just going to change that color to something a bit more neutral. And I'm going to extend it to the right. Okay, that's going to be my target. I'm going to tell you why now. It could be this supply zone, it could be that one. That one's just very low for me. You want a decent profit, a decent target. You can also target the one up here. So what we're going to do now is we're going to see boom, 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 market runs. Okay, market broke structure. We have a zone here. I'm going to zoom in. I'm just going to fix the zone for you. I want to show you how I identify this. We're going to draw that zone. Now this is a daily zone, okay? So this is quite big. What I'm going to do now, I've got that little zone because market has broken structure. Now I'm going to go from daily, I'm going to go to 4 hours. Now yet again, please note what I said. That confirmation happens on different time frames. Let's zoom out here. Yet again, I'd recommend using a computer mouse if you don't have a proper Apple mouse. Now in this zone, important, in this demand zone, let me change the colors of this thing. You see how many candles we have now, which was, like before it was one red candle, it was one green candle. Look at the candles we have inside now. Okay, so I'm just going to change this color for you guys. So now look here. What we could have done inside the zone, you see how that's also a piece of structure? You have another zone. So you have a small zone inside the big zone. Okay? Let me extend this right to you. So you have now this zone inside the big zone. Now, even if the market taps into the small zone, you're going to put your stop loss below this. The market pushed up, market comes back down. Now, a general rule, and here's what you guys can do, because I know a lot of you guys work full-time jobs. You can place what is called a buy order, like a buy limit or a sell limit, or a buy stop or a sell stop. Now, one of the ways, or one thing that happens is, the market will come back down to the zone, and on a very small time frame, it'll break structure. So you can see in this case, we didn't get that wick. Okay, but what could have happened? Let's go down to a 1 hour, for example. Like I want to show you guys, I want to break this down with you, for you so you can see how the candles develop inside that zone. Okay, we're going to go back down here. Okay. So now remember, it is because of this impulsive move. That's why we're not going to look here, we're going to look here. Now, what is this? This is a 1 hour. Okay. You can see this is an impulsive move, a corrective move, you have a failure to break structure. And the next structural break only comes from this. But now remember, we already have the zone, the big zone, and we have the small zone inside the zone. Look at how the market tapped into this. Now you see this. Don't tell yourself that's a candlestick pattern you saw on Google, it's irrelevant. We're going to go down to a 5-minute time frame for now. I want to see if we can get this much chart data. I'm hoping we can, because I really want to show you guys how this works. Okay, we are down here. I actually think this is the top zone, not the bottom one that we want. Yeah, I think this is the top zone. This is actually one of our targets, which is not where we want to be. Alright, we can't go further than this. I'm going to tell you exactly what happened on that. Unfortunately, we can't go back further than this. Let's go 15 minutes. So what happened at that point? Let's go down. 5,000 bars. That limit was never there, but anyways. Remember market structure, okay? Impulse correction, impulse correction. The same thing happened going down. Impulse correction, impulse correction. Okay? Now, what happened when that market, remember, we drew the zone inside of the zone for that impulsive move. The market came down. There's a reason we didn't use that second tap after the initial start of the zone, because that's not part of it. So what happens is structure broke in that zone. I'm trying to show it to you guys. Here we go. Here we go, here we go, here we go. So you see this, market came back. This is now on 15 minutes. On a 5 minute or 1 minute, you would have seen it better. You would have probably gotten your entry here. Nonetheless, I'm going to show you this now. You see I have a little high there. And now here you have small amounts of structure. Okay? Small amounts of structure. You've got zones on zones. Boom, boom. You've got a break of structure there. So what you can then do is you can place an order, or we're going to do this. We're going to put a buy order. Let's put it here where we decently broke structure. So we broke structure properly because we made a new high compared to these highs. We then came down. Do you see this little impulsive move as well? This is also where you could have gotten one of those wicks. But anyways, you would then place an order here. You will then put your stop loss below the big zone. Important. And just below it. A couple wicks. Baby wicks. Now, you can either target this little supply zone here, which is already a 124, or you've gotten this entry on a 15 minute. Now, you will find out on volatility, we get our entries on a 2 minute time frame. Okay? It's a zone inside of a big zone, and on that zone, inside the big zone, you will have another demand zone. And it's going to retest that third or that second demand zone. Depends sometimes. Remember, the market varies. That's where you're going to place your order. Now, I'm going to go back to the 4 hours, because remember, we have a target. Okay? We have a target. We got our impulsive move, which was this, that broke structure. The zone inside the zone. We have our order here with our stop loss just below it. You know, that's fairly decent. Can I extend this to the right? I'm not sure. No. But remember, we placed a supply zone as a target, which is up here. Now I'm just going to go and I'm going to draw that all the way to just before we get to that supply zone, because the thing is, when a market gets close to a supply or demand zone, it already starts not changing direction, but it starts losing the volume of power that it has. Now I want to show you this. I want to extend that to the right now, so you guys can see exactly how this trade ran. Now given, this was over the course of how long? This is Forex. This trade you would have taken on the 3rd of November last year. It would have only hit your target area on the 13th of December. But this is what I want to show you guys that makes NelCapital different. It's a risk to reward ratio of 1 to 21.85. That's not a profitability rate, that's just a simple risk to reward ratio. That means if you risked $100, you would have at least made $2,185 on this trade. At least. Given you have more technical things like swaps that happens when you hold trades over long periods of time, we're not going to cover that today, just simple basics. Let's go back to that daily time frame, because now I want to show you exactly what happened here, where we entered. We entered right here, look how small that red area, that is the little amount that we risk. Look how small the risking amount is compared to what our target amount is. Now, also, what would have happened if we had a fake out and the market pushed down? Well, we would have lost a tiny amount. And that is how accurate we are. This is the accuracy I'm teaching you guys. Now, you can do this on any pair. Sometimes you're going to get that wick. The wick that I showed you happens mostly on VIX 75. Now, another thing. What happened now is I wasn't able to show you all the candles. I'm sorry, TradingView doesn't allow that. But if you don't get the wick entry that I've shown you, you've got the big zone, the daily zone, or the 4-hour zone. Inside that, you can identify a 1-hour or smaller zone. Market's going to come back, and you will find that that second zone, it's usually the way it starts is usually like in the middle of the big zone. So you can usually place entries in the middle of the zone and have a stop loss just above or just below that major supply demand zone. Do this on a small time frame, target big time frame zones, and you will get trades like this. I'm going to stop with the charts for now. In fact, actually no. I showed you guys a NASDAQ trade. I want to show you exactly how this trade was taken because it is done in a very similar style. Let's go over to NASDAQ. Okay guys, you can see NASDAQ is still running. What this is down here is just a trend line that just indicates the market going down. Now I want to show you this. This is on a daily time frame. I was on the ships when I saw this happen. I was actually teaching someone to trade. Look at this major supply zone. Goes down. Okay, we have a similar equal zone there. So no break of structure here, but it's also a failure to make a new low. That's a double bottom. And then from here, look at this massive demand zone, this massive impulsive move. Now, yes, right here, I just put a line here. This is not a support line. This is just a line to show. This is where the market like to open. That's where it like to bounce off a bit. Okay. Let's go into smaller time frame. Let's go to 4 hours. So look at this. I just put this line here. It just gave me an indication. It's not a support zone. Just ignore it. You look at this. This is where that zone inside the big zone would have been. I didn't even draw it. Right. There's your small green zone. And look, it's at the bottom of this major zone. So what did I do? I placed my entry at the bottom. I placed an order, okay? You can see the market came into my zone, but it only tapped me into the market right here. Now, why did it come this far down below this box? Because Devochi said put your stop loss just below the box. Remember, we didn't get wicks here to give us an area, and I wasn't watching the chart when this happened. I put an order there. But what did I notice? And this is why guys have to be awake when you trade. What did I notice? Even though this is my demand zone, okay? Even though this is my demand zone that I'm targeting to buy from, what did the market do next to it? There's another zone. Look at this wick. This is why I don't ignore the wicks, okay? Now, I didn't target this low of an area, but where this push came from, that started like that broke initial structure, just next to it on a zone that is already quite supportive. It's not a support zone, but it's a supportive zone. Look at this wick, okay? That kind of tells me, okay, something happened there in the process because already here it started like bullish momentum started kicking in, okay? Still no break of structure. From here, breaking of structure. Let me just draw it for you guys because I'm not sure if you're going to understand what I say. All right, there's your high, there's your previous high, equal low, double bottom, okay? Breaking of structure, boom, so the market has to come back down. But look here, you see these candles or these wicks? Don't ignore those wicks because those wicks told me, okay, something happened more or less here. It might be fundamental. This might be a fundamental move, but something happened here which could drive the market down. Now, the other reason I put my stop loss way below this wick, you see it's just below it, like barely just below it. Because usually your buy zones, the zone within the big zone, is more or less in the middle. But because this other zone was so far down in my major zone, I was like, okay, it's going to be unrealistic to put a stop loss just there. Because look at this candle, or look at this wick, look at this wick, look at this wick, and look at this wick. NASDAQ has a lot of fundamental influence. So it's like, okay, more or less here is where the market does a thing. You see if I put it on that wick, it's just below it. So it's like, okay, let me give me a bit of breathing room. Other than that, nothing really much happened. You can clearly see here, this is on a daily. Market, look how early I entered, okay? We haven't even broken structure yet, but I'm in just because of an actual break of structure in a big time frame. Don't trade the 15-minute, 1 hour break of structures, trade the big moves. That's how you get small stop losses, big TPs. This is a 1-to-7, almost 1-to-8 risk reward ratio. I took this trade, 2nd of December, and we're still up. It didn't come close to my TP, and this, most people would have put their stop loss obviously just below the zone if they know this, but because I just looked a bit left and saw, okay, we've got some wick areas in here, which means there's maybe some liquidity, just gave myself a bit of breathing room. Okay, it's really simple. It's really simple. Now I'm going to end the screen recording. We're going to cover one more thing. We're going to cover how to get you guys set up on MetaTrader. If you have an iPhone and you don't have MetaTrader 5 on it, I don't use 4, I use MetaTrader 5. It's the newest. Apple has banned it from the iPhone because of scams that was happening, because of people getting scammed. Apple was like, we don't want to be a part of this culture, of this trading culture that where people scam people. So they removed MetaTrader. Now we're going to use Deriv as a broker. Deriv offers synthetic indices, which is volatility 75. VIX 100 offers all that. It also offers a currency account. We're also going to use that for Forex. The reason I want everyone to use that, even if you have a different broker, the reason I want you to at least put some money into this, or start with a demo account, is just so that our numbers line up, especially when we trade Forex. If I say buy this price, it's going to be that price. You can only trade VIX from Deriv, so our prices will always line up. Now, take a quick breather. On the last bit, I'm going to show you how to set everything up on your computer. If you have MetaTrader on your iPhone, great. I'll make a short video of that in the future on how to use that. But for now, mainly focus on using your computer, getting everything set up, and learning how to use it. Okay, so final section of this video today, what we're going to do now is look at setting up a Deriv account and look at setting up MetaTrader on your computer, as well as just a quick overview of how to use MetaTrader on the computer. So first, what you want to do is we're going to go back to our browser. We're going to go to, no, that's all right. We're going to go to deriv.com. Okay. Deriv.com looks like this. Now, also from here, you can download MetaTrader for your computer. So whether you have a Windows or a Mac, you are able to download from the Mac App Store. So Deriv MT5, download for Windows, download for Mac. You can also get it on Google Play if you have an Android. Otherwise, I do believe they have an app called DerivX. That's a bit of a different thing, but you can use that on your phone. Today, we're just looking at MetaTrader. Now, you guys, what you're going to have to do before you can just log in, if you have never used Deriv, you cannot log in. You have to create a demo account first. Once you have a demo account, it's going to give you the option to make a real account. So you're going to make a demo trading account, you're going to create a synthetic or Forex account or finance account, and then from there you have the option to make a real account. Once you make a real account, you will then have to obviously submit your name, detail, all those things. But then it's going to look similar to what it's going to look now. So I'm just going to log in here. And you will see right now I have a clean account here for everyone. There's about 6 cents here. So once you've logged in, you should have something similar like this. You will see there is a Forex account. I've added a clean account there already. And then on this side, you also have demo. So you can make a demo account. You can have so Deriv is going to be your synthetic account. That's going to be the one you're going to use for volatility, and then a financial account is the one you're going to be using for Forex. So what you want to do is, let's say you want to add one for VIX, you're going to say add. They're going to ask you to create a password. I already have one, so I'm just going to log in. That's the wrong password, that's fine. You see here, once you've signed in with your demo account, you're going to have these options. If you go to real account, they're going to ask you for another one. I've got a real account set up here. It's a clean account. This is also the account I'm going to be using to trade along with you guys, and we're going to track our progress. But what you want to do, go to demo, just either make a demo account for one of these. It's going to give you then something similar to this, where you are going to have, trading, where's this? You're going to have an account number, which I'm just going to blur out here. And then you also, the password that you have is the password you are going to use. Now, very important, if you click on trade, it's going to give you a bunch of info here. Which broker to use, which server to use. Sometimes the Deriv has server 1 or server 2, your login ID, and then the password that you have made. Okay. Very important. You're going to use that login ID and the password that you've made. Cool. We've covered this section now. If you want to deposit money for your account, you're going to go over to cashier. You're going to go over to deposits, and you're going to choose one of these options. Now, Deriv is very nice. They give you the option to use either crypto, or you can simply scroll down and use your Visa or MasterCard. I think it's up here. You can use ZingPay to make an EFT. Let's maybe go back a little bit. Anyways, they give you the option to make. Okay, so you can just make a deposit there. Then what's going to happen is your money is going to show up in a US account. It's not going to show up in your actual synthetic account. So you might think to yourself, well, what the hell? That's where you're going to go over to transfer, and you will see your money is going to be here. You will then just transfer it over to your synthetic account. I'm obviously just going to blur this info out. And then once you click transfer and you are logged in on MetaTrader, you will see it shows up there. If you make any profits, you will then come back here. You will swap this around for synthetic, and you will then just transfer the profits from your synthetic to your US account. And then once you've done that, you can come to the withdrawal section, and that is where you can make withdrawals. Awesome. Now what we're going to do, actually I didn't want to close that, actually I just want to go back there. So what we're going to do is we're going to now look at how the MetaTrader for the PC works. Now whether you're on PC or whether you're on Mac, it's going to work the same. So what you want to do is you want to open MetaTrader. First time it pops up, it's going to look something like this. It's going to have a bunch of pairs here. It's going to say something like Meta quotes demo accounts from Meta Corps. You're not going to use that. So you want to close this strategy tester down here. And for now, we can also just close the toolbox. And let's look at these windows. I'm going to say window. That should be down here somewhere. Yeah, we're just going to fit them. So for now, once you open this, first let's link your actual account. So you're going to go over to File, log into, or no, you're going to say Open an account. It seems very counterintuitive, but you're going to say Open an account. And then you're going to type here Deriv and just find your company. It should bring up Deriv Limited right over here. You're going to say Next. Sometimes this takes a while to load. Then you're not going to say open a demo account. You're not going to choose any of these two options. You're going to come down to connect with an existing trading account. Even if you use a demo account, this is where you're going to put in your details. So I'm going to go get that login ID that I need, which is this one. I'm just going to say trade. I'm just going to copy that login ID. Copy that. So we're just going to go here, login, put that copy ID. Mine is Deriv server, and I'm going to put my password in there. And I'm just going to say finish.
Incoming mail.
Cool. Now you'll see what has happened is the Euro USD stuff doesn't load. This is because it's a synthetic account that I just added. Okay. So what we're going to have to do is we're going to have to go to pairs. And you see here where it says, I'm going to close data window, where it says volatility, volatility, volatility. This is because it's a synthetic account. So we can close all of these Forex accounts. If you opened your Forex account, they should have loaded with all the right things. For now, just close them. At the bottom, we have trade. You can see there's no money currently in there. We have exposure, history. Your history is going to show up here, and we have news and all that, but we're not usually going to use the other tabs. We're just going to use the trading tab. So to open a pair, you're going to right click on it and just say chart window. Very important. Here's what I want you guys to do. It's going to have green, black. It's going to be very ugly. Right click on this. And this is actually kind of important because colors do play with your psychology. Sometimes I like to change my candles to gray and blue. Sometimes I like to just make it red and green. Or like what I'm going to do now, I like to have gold and black because that's NelCapital's colors, gold and black, and then I'll have it on a light gray background. So we're going to go to properties, we're going to go to colors. Now, background, I'm going to give it a very light gray color. I'm going to make my foreground, that's fine, it can stay white. Grid, the grid we're going to switch off. Bar up, that is your bull candle. Bar up, I'm going to make gold. Where is gold? Orange. Let's make it orange for now. That's your bar down. Bar down, I'm going to make black. It's going to be fine. And then your bull candle, we're going to make orange again. And your bear candle, I'm just going to make black. Okay, that's fairly clean. Okay, you can see that is kind of cleaned up now. We are going to remove tick volumes. We don't use that. And then we are also going to click the following grid. We take away. We're going to put chart shift on, so you get a little bit more of a gap here. And that is pretty much it. Now, if you want to apply this color to all the other pairs, because what's going to happen is if you're going to do this now, it's going to give you that same ugly thing. Okay, we don't want that. At the bottom, you can switch between your open charts, or you can close the chart right here. So what we have here, to zoom in and out, you can use plus and minus, the equal and plus sign. You're going to right click, templates, and then you're just going to save this template. I'm going to call it, let's just call it gold. I know it's orange, I'm going to call gold and black. Now, capital, and that's it, that's fine. It'll open this, it'll always open this. So now if you open any other pair, let's do VIX 50 for example, you can simply right click, templates, load a template. I'm going to open that one, boom, done. It applies all the settings, it's all done. So once you're in here, this is pretty much kind of set up straightforward, but we're missing a couple of things. Now this doesn't have everything that TradingView has, but it gives us enough to do proper analysis. So what we have on right now, let's go to 75. What we have on right now is a thing called auto scroll. Sometimes you might want to turn this off, and I'm going to show you why. Look at this. If I move back and I pick up my mouse, you see how it pushes the chart back the whole time? However, if I turn auto scroll off, anyways, you can actually move back very far, and you see it doesn't jump forward. However, if I put auto scroll on, it's going to move back. Cool. So now you have MetaTrader, you have your derivative account set up, and you have MetaTrader set up on your computer. You're pretty much ready to get trading. However, you see up here we have a horizontal line, we have a trend line, we have a equidistant channel, and I actually like this channel because if you draw something like this down here, we can change all these properties. But let's say you draw something like this and you want to make a nice even channel here. You guys will learn how to use this later on. You can customize it. It's quite nice. MetaTrader has been quite friendly when it comes down to these things. I'm going to make it blue, give it a nice thick line, and that's pretty much it. Okay, we're going to unselect it. So that's nice, but we don't have all the tools that I want us to use. So you see this, we're going to pretty much just come up here, right click on it and say customize. Now, here's what we want, and please guys, add this. You're going to scroll down. I do want, for me personally, I want the Elliott wave, and I'm just going to say insert, and I want the corrective wave because I use this in my analysis to show you guys what we're looking at. Then I definitely want a rectangle, and I also want an arrowed line. This is things, you don't need the arrowed line, this is what I'm going to use, but if you want to, for example, do analysis and share it with a team and show them what you see, definitely use this. And then I'm also just going to add a text label just because I'm going to use those tools. Cool. We have one more thing that I want us to set up. The colors and stuff you can change later, but for now, very important, because you're going to use supply and demand zones, we need to set this up. Just click the rectangle and draw a rectangle. You see you have this kind of weird rectangle and it's not very visible. You're going to right click on that and just say properties. What I like to do is I like to give this a color that stands out from the colors that I already have. So I've got a gray background, not the best to use that. I'm going to use something that contrasts very nicely. Maybe I don't have green, so maybe let me use, no, I'm going to use something neutral. I'm going to use that, and I'm going to visualize, I'm going to parameters, I'm going to fold this, I'm just going to click OK. Now, this is very nice. Maybe I'll make my background a little bit darker. just for the sake of this, I'm going to make my background maybe like a dark gray, dark slate gray. That's also ugly as hell. I don't like that. That's just going to make me not want to trade. I'm probably going to do something like this. This is a very dark gray. That's perfect. This is what I want. So now you can see my candles differentiate themselves nicely from the background. And if I put my zones over here, you can see what happens. It changes to a weird color. Okay. Now you can go and you can change this around. Just very important. I want you guys to have this. I want you guys to have your colors set up. I want you to have your charts clean. I want you to have your rectangles also set up. So I'm probably going to just change this color. It doesn't work too nicely for me. Maybe if I do something like a white. Also, that's alright. I'll change it a bit later after the video. But this is what I want you guys set up. I want you to have your derivative account set up. Whether it's a demo or a real account, doesn't matter. I want you to have MetaTrader set up with your colors and everything in here. I know you guys can see the laptop, it's right below the screen. I want you guys to have all this set up. And then also your rectangle, because you're going to use it. Now, we're not going to do any analysis on this right now. How you change time frames. If you don't have this, a lot of people don't have this 1 hour, 4 hour. They don't have these things, okay? If you don't have it, you can always just right click, hit time frames, and you will have everything down here. Okay, you can also see here in minutes, we have 1 minute, 2 minutes, and then 3, 4, 5, 6, 10, 12, 15. We will usually go down to an hour, 15 minutes, and then 5 minutes maybe, and then for very, very, very tight entries, we will go down to 2 minutes. You can use the 1 minute, however the 2 minute time frame just gives you that little bit more structure, which is what you want to see. It makes your 1 minute structure a lot more clear, if that makes sense, just because you have a little bit of more movement that it shows. Now, this is VIX 75. Let's actually do a proper analysis on VIX 75. So if there's anyone here that trades VIX 75, we can look at the structure right now and you can copy this and then use it. So what do we see here? This is on a daily. We have this massive impulsive move, correction, impulsive move, correction, failure to break structure, another impulse. VIX is all over, and that's also because the US market has been all over, so investments have been all over. Now, this is a daily zone down here, a daily demand zone, because from here we have lows, 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 and we have a break of structure. So VIX technically does still need to come down. So this is what I'm going to do on VIX 75, and this is some live analysis for all of you. Just get that wick down there. Important. You see how this square or this rectangle has these boxes on it that you can use to draw it. If you have multiple things drawn, like let's say I draw another zone here, just like that. If I now press backspace or delete, it's going to delete everything. So whenever you draw something like this, make sure to right click and just say unselect all. Because if you draw a lot of things and then delete one thing, it's going to delete everything. So for now, I'm just going to delete this one thing. And then what we're going to do is I will say my next supply zone for a good sell. Let me see. Let me draw something like this. I want to see where's the low point here. And then from here, this low got broken by that. But I'm going to use this big one because this is a move inside a move. And this is another daily supply. And draw that out like that. So that will be my all-time long-term buy TP or take profit area. Okay, you see how it deletes that one thing? It's very finicky. Now you're going to ask yourself, why not this? Because you can see with that tap, it's already been tapped. Once a zone has been tapped, it's invalidated, you can't use it. A market will never be tapped more than once. Now let's go in from the daily to the 4-hour time frame. So we know time frames, I'm used to doing this. So now what we have here, we have structure inside structure. We have structure broken. What do we have here? We have a little, you see our market like moved up. We have a little break of structure here as well. So what's going to happen is you can possibly almost sell this, but we're going to go down and just mark this little supply zone. This is a very small impulsive move, but this is also 4 hours. So it's technically a big move on a small time frame. Now, before I show this, do you see what happened here? Market pushed away, obviously broke structure from those lows, because remember, market pushed up, down, these are all candle lows. So these, like that's a low. You will get easy, it'll get easier to identify these things, and right now you might be thinking, but it doesn't look like what I've shown. On smaller time frames, you will start to see these things. You can see how the market pushed, like it pushed down again. You see how it tapped in here? That is where that structure change happened. This is where you were supposed to have sold VIX 75, okay? Because even though it's back in the zone, it's probably just tapping into one of these other zones. So this zone has already been, like, it's used. So I'm not going to use that. Right now, we can just leave this as is. Any other structural, well, no, let me actually draw it for you. Even though it's been tapped into, we haven't broken structure again from that push. I'm going to leave it right here. We need a proper structural break. So from the 4 hour, this would be TP1, and then we can target the other area for TP2. Time frame is going to go down into 1 hour, so we can see what is going on in this market. Okay, now this is very interesting. You see what happened here? We have a zone. We have this zone inside the zone. Let me draw that for you. We have a zone inside a zone. Now, when this market tapped in here, you could have sold exactly because you would have placed your entry. Yet again, remember how I said it's usually in the middle of the big zones? Now just look, this is confusing. Just look at this. You see it's very close to the middle of the zone. You could have pretty much placed your sell entry here, your stop loss just above there. It would have wicked it and taken you straight into profit. Now yet again, we've broken structure here. What do we have here? We have another, so this zone has already been invalidated right now. But what you did do is you also created another supply zone inside this. So I'm going to take this and just do that. Now, you guys could have caught a massive sell from here down to one of these zones, and it would have tapped it already. So this is pretty much what you would have left right now. Overall, I'm still bullish. I'm going to wait for this to just fall off. As soon as it breaks below this, if you trade VIX 75, mark this out right now because you will make a lot of money from this trade. As soon as it breaks below this level, you are going to look for supply zones in the impulsive move that was created. You are going to then place a stop entry or stop limits or sell limits in the middle of that zone, and you're going to place your stop loss a couple pips above that zone. Okay, it should continue down. If from this point, because this zone here was already retested, it's invalidated, it's no longer a strong zone. If the market pushes up, that is then where you would use your self-study of continuation and reversal patterns to obviously target the higher time frame. So the daily, that's when you can swing trade. But as you can see here, we've broken structure. I firmly believe VIX has to come down to one of these zones down here, most probably the big one. Over time, it might take a couple of days before going up, unless what's going to happen is it'll come back up, retest the zone, and continue with a bearish down structure. Because remember, you've broken the structure on a small time frame. But look at this, look at the big time frame. On the big time frame, VIX 75 hasn't stopped being bullish in what seems to be like almost a year. As you can see, this whole thing going down. So only once we actually break above one of these major zones is where we're going to start looking at long-term buys. But for now, you can buy this up back to the zone because this zone has to be retested. These zones are all supply zones which have to be retested or violated, and that is where you want to jump in on the buys. So that's been it for the first video. I know it's a long one. I know you guys are probably going to have a lot of questions. If you are experienced, please look at supply and demand, look at what I've shown you, look at what I've shown you how to enter. It will change the game for you. Okay, forget about Fibonacci, forget about all the other crap you were taught. Get a clean chart. You now have my official bias on VIX 75 as well. I know we have a lot of VIX traders in here from my NelCapital team already. This has been a long video. Please take your time, work through it. I will open up the chat features later again tonight so you can ask questions and post comments, and please tell me what you think about this first video in the discussions group, because it'll obviously help me improve on the next ones that I post out there. I hope you've learned something from this video today. I hope you've learned how to do a lot of things. Actually, I forgot something, but I hope you've learned how to do a lot of things. And yeah, I trust that what we're going to do in this community is just going to be a lot better. So, how you actually place a trade? We need to kind of still cover pips and lot sizes. I'm going to do that in a quick video, maybe on Monday. How you actually place a trade? You can buy and you can sell. Now, if I had a demo account, I would show you, but on MetaTrader, you can buy and sell from here. So you can trade, buy limit, sell limit, new order. It's going to give you kind of the same thing as this. Now, when I share trades, when I share signals, I'm going to share either a buy or a sell stop, which will be placing an entry, which will be taken for you, or I'm going to say buy now or sell now. I will give you a stop loss and a TP. In here, your volume, that's going to be your pips. Now, in Forex, your volume only goes 0.00. For VIX 75, because it is so volatile, you can go 0.000. So in Forex, your smallest lot will be 0.01. In VIX 75, your smallest lot is 0.001. Okay. But on VIX 100, your smallest lot is 0.02. On VIX 50, your smallest lot is 3. So those things work a bit different. I will cover those in different videos. But for now, I just wanted to get you guys set up. I wanted to give you a basic understanding of the market. For those that are experienced traders, hopefully you work through this video and you think to yourself, holy shit, okay, this is a new level of accuracy that I've been shown. We will get into a lot more detail in future videos. For now, I just need to get this video out to you guys so you guys can get set up on your computer. You will not use your phone for trading. Yes, you will use your phone to view your trades and maybe to close trades. You will not analyze on your phone, okay? You might take trades from there, which I will send through, but you will not analyze. You will only use your phone to view your trades, maybe share an occasional screenshot or two to flex on the people who's not in this team, and pretty much that's it. You're going to use your computer for analyzing or for analysis, for most of the times execution as well, because there's like nuggets you can use. I will make a video on like the nuggets, which makes trading really easy on MetaTrader on your computer. It makes risk management and calculations really easy. We're going to get into that in a future video. For now, thank you guys for obviously joining. Please give me your honest thoughts. If you want to go to social media with this, you're welcome to. I don't care. But please give me your honest thoughts. I hope you've all learned something. I hope the experienced guys have learned a lot about supply and demand. It's going to be a new way of trading. You might not see it right now, but once we start actually trading together, once I start sharing through signals and doing my analysis and you see the stuff play out, it's going to start making sense. Have a wonderful evening, everyone. Take your time, work through this. There's no more content coming over the weekend. I'll probably be back filming on Monday. Let me actually close this screen recording. I will be back filming on Monday again. More content, more like shorter form videos, but for now, work through this. Get trading, well, not get trading, work through this, study, be patient, get your things set up, and I will see you guys next week with new videos, new content. And please let me know in the discussions group what you guys think I should improve on, what do you guys want to know so I can cover those. Remember, this is a very basic video. A lot more detail is to follow in the future. Have a good one.